what's interesting here, if we take a look at these most recent attacks and even the attacks by Israel, we're still about 10-11% off the 2025 highs. So it seems as though that the strategy that's being undertaken here of late is to sell into these geopolitical rallies.
And we've seen the probabilities for a closure of the strait climbing, but we still think that's really a break glass scenario for Iran. That would bring the weight of the world and maybe more importantly, the U.S. Navy down on them to reopen that strait, as nearly a quarter of global oil transits through the Strait of Hormuz every day.
And everybody in the market is trying to assign a probability to that and price that in. And we think now there will be an additional geopolitical risk premium. But as you said earlier, what we've seen in the market this morning is that Brent oil spiked to higher than $80 a barrel, but then paired those gains, which tells me that the market interpretation of the current situation is that maybe there will not be a significant retaliation by Iran.
Part of it is also why they're remaining elevated. And I think like what you need to see to the latter point is some more fundamental support and less of it attributable to the geopolitical risk premium, right? Like I think as long as folks believe the increase in prices is temporary, they're not likely to change much behavior.
So since the escalation started roughly a week ago, so we're talking about June 13th, that was the big day. European gas prices have surged 20%. They opened today at more than 42 euros per megawatt hour, and since have settled at around 41.
And really, this whole thing just reinforces supply diversity. This isn't the first event that's happened in the Middle East. It happens frequently, and the question becomes Strait of Hormuz, all of that capacity, about a fifth of global capacity comes from Qatar and UAE. What would happen? So, it really just helps the US if they cut it off. If not, prices go up because the US, most of it is contracted, right? But it's technically spot because most of the contracts are with portfolio aggregators or traders. So it's destination flexible. So the higher prices help the US suppliers and also those companies that have contracts with them.